Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The Reserve Bank Board has cut interest rates by 0.25%, the first reduction since 2020. With inflation on its way down, the move was widely expected. But in the words of Reserve Bank Governor Michele Bullock, the board of the bank remains alert to the surprising strength of the labour market. She warned there's nothing to suggest that the Reserve Bank Board will keep cutting rates while inflation isn't quite under control. Gareth Aird is Commonwealth Bank's Head of Australian Economics. Gareth, welcome back to Fear and Greed.
It's nice to be back, Sean.
What was the tipping point for this rate cut? What was the deciding factor for the board?
Oh, look, I think if you had to point to one piece of data, it was the Q4 CPI, which we got out a few weeks ago now. In fact, it was several weeks ago, and we've had this kind of vacuum where a lot of people between that CPI coming out in late January and the rate decision yesterday have been speculating as to will they or won't they cut. But we were pretty confident at Commonwealth Bank when we saw that Q4 inflation data, which for the trim means showed an increase of 0.5% on the quarter, and the RBA had thought it would come in at 0.7%. And we thought that downside miss would see them cut the cash rate yesterday. And then if you had to point to a few other bits and bobs that would have given them confidence to cut rates yesterday, it was that wages data in the third quarter of last year came in a little bit softer than they had thought. And then also the national accounts, which came out back in December of last year, were also a little bit weaker. So that body of evidence, particularly on the inflation side, was behind the decision yesterday to, as the governor said, take rates a little bit away from their current level of restrictiveness, albeit they are still currently restrictive.
Do you think that the trajectory of the economy has surprised the Reserve Bank a little bit? Michele Bullock did talk about inflation easing perhaps faster than they had thought.
Yeah, look, it has. In fact, two things have been a surprise to them. And one of them is that inflation has moderated more quickly than they thought. And the other thing that surprised them is that the unemployment rate has basically held steady through last year at 4%. Now, that's an unusual kind of configuration because normally if inflation's coming down more quickly than you thought, unemployment would be rising more than you thought. But as it's turned out, the RBA's effectively and Australians more generally have had the best of both, where we've had more disinflation than was previously thought, but also a labour market that's held up better. So I think the governor yesterday referred to that as, good outcomes that should be welcomed. And ultimately, we got two favourable surprises in terms of both inflation and the health of the labour market.
Okay. What about the next move then? It seemed to me that Michele Bullock was quite strident in the view. She said it wasn't a lay-down misère, it was a consensus decision. She'd be cautious about the outlook. She wasn't exactly saying there's another rate cut on the way.
No, I mean, I think at the end of the day, the board itself had to debate whether or not it was right to move the cash rate down or to leave it on hold. And I think if the governor basically said, all along we knew we'd be cutting rates, then it would sort of imply, well, what exactly were you talking about for so long over your day and a half? So I think it just shows that they had a healthy discussion around, both options. But ultimately, they concluded that the right thing to do was to take the cash rate down a little bit. And, she still wanted to point out that policy is at a restrictive setting. So the way to think about that through the lens of them cutting rates is they're not putting their foot on the accelerator of the economy. They're just edging it off the economic brake, for want of a better phrase. And that's what you really should be doing if the inflation data is giving you the green light to do that, because all along they've wanted to preserve as many gains as possible in the labour market. And all along they've wanted to get inflation down. And if we're getting to the point where the data is basically showing that's occurring and you think that policy is restrictive, which they do, then it makes a lot of sense to cut rates. Now, I think the reason why she didn't want to commit to the future path of rates is that they've been surprised by the strength in the labour market. And I think if that were to hold, they'll still harbour some doubts as to what the pace of or what the trajectory for inflation looks like over the course of this year. I think if the unemployment rate had been going up, they would be more confident that inflation will keep coming down. But because the labour market stayed more healthy than they thought. They're just a little bit cautious on what inflation might look like over the coming sort of 3 to 6 months. And therefore, they don't want to get anyone's hopes up and say, look, we think we might be going back to back, because ultimately they don't know. And they're just going to be guided by the data as it comes in, not just between now and the April board meeting, but over the first 6 months of this year, as to what future moves in the cash rate actually look like.
The difference between the Reserve Bank economists and people like you, Gareth, who runs Australian economics at the Commonwealth Bank, is that you have to have a call on that. They're allowed to say, well, we don't know. Do you think there will be more rate cuts in coming months?
Yeah, we do. Well, when we say coming months, we've got the next one penciled in there for May. So if they were to move the cash rate lower in May as being the next move, that would indicate that they're on hold in April. And I think, provided the labour market data looks pretty good over that period, they're more likely to wait until May to get another update on inflation, just to confirm that disinflation track that they've laid out in their forecasts is still happening. And therefore, they would remove some more restrictiveness, because they still think policy is restrictive. I think the only way they would be going back to back and cutting at the April board meeting, based on what they said today, as if the labour market data was to show that there's more of a loosening taking place over the next couple of months. And so on Thursday, we get an update on the January labour force in the form of the January labour force survey, and then we get the February labour force survey before the April board meeting. So I'd be looking at those two pieces of data as to whether or not they might cut in April. The other thing too is we're still getting monthly inflation data. Now, that is a little bit more choppy, and also it's always a partial read on the CPI basket. But having said that, once you get 2 months of the quarter, you get a pretty good idea as to where that quarterly number is going to come in at. And they will have 2 months of the CPI data ahead of the April board meeting. So long and the short of it is, we think rates will still go lower through this year. We think it's more likely than not the next one will be May, but they didn't. The governor didn't categorically rule out April, because they know there's still a fair bit of data to come out between now and then.
Stay with me, Gareth. We'll be back in a minute. I'm talking to Gareth Aird from the Commonwealth Bank. What does all this mean, the rate cut, for homeowners, for consumers, business confidence? I mean, Michele Bullock yesterday talked about every little bit helps, and I'm sure it does. What's it mean for the economy? Does it make much of a difference?
Well, I think that's right. I mean, every little bit does help. Now, in terms of the pure mechanics of a 25 basis point rate cut on home borrower cash flow, it's not a huge amount. However, if you think about what happened last year, for a lot of last year, the RBA was talking about potentially raising rates further rather than cutting them. And that really weighed on consumer confidence and business confidence to a lesser extent as well. So I think that the fact that the RBA has started to cut rates yesterday, that will see a pickup in confidence. It's not a huge change for the average home borrower from a cash flow perspective. I think households are going to be feeling better about the outlook from here, knowing we're past the peak in rates, knowing that a further reduction in rates is more likely than not. And that should help to generate a modest pickup in spending. And ultimately, from the spending side of the economy has actually been pretty soft over the past 12 months or so. And if we can get the economy growing to something more like 2 to 2.5%, which is more like a trend pace, then we'll be seeing outcomes that have been historically sort of consistent with unemployment not moving up too much. So I think in the very near term, we'll look to just measures of consumer confidence in our internal spending data at the Commonwealth Bank for any kind of response. But I think from a psychological perspective, for many households and businesses out there, that rate reduction yesterday would have been very much welcome.
We're almost out of time, but we should at least mention the statement on monetary policy, which also came out yesterday. The Reserve Bank did say that there's signs of recovery in the household sector, which is good news. Now, people like the Commonwealth Bank probably know more about that than almost anyone else because you have real-time data. Are you seeing that?
Yeah, look, we have seen that in the back end of last year, where our spending data actually picked up a bit relative to the September quarter. Our data for January, though, looks a little bit softer. and the spending data is pretty choppy month to month. I think it would be a surprise if we didn't see some pickup in spending, just given how weak spending growth was in Australia for about 18 months or so. We're actually on a per capita basis, it was going backwards. So that story couldn't go on indefinitely. And there were the tax cuts that came through that saw households start to see a pickup in income, coupled with the fall in inflation has actually helped household purchasing power. So there's definitely some signs there that activity has picked up a little bit, but not to the kind of levels where we should be, I think, worried about the outlook for inflation. It's more that the RBA wants to just keep a cautious message going at the moment, knowing that there's plenty of economic data to trickle in between their board meetings.
Gareth, thank you for talking to Fear and Greed.
Thanks for having me, Sean.
That was Gareth Aird, Commonwealth Bank's Head of Australian Economics. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.